The basics for investing in stocks. Although they are unpredictable over the short term, stocks have delivered superior returns over the long haul. Financial strength. Although not technically a measure of value, you should have a sense of how much debt a company is carrying. Debt isn't necessarily bad. Used judiciously, it can help a company boost profits. But too much debt can be dangerous, particularly when the economy weakens. If sales and profits slump, a highly indebted company may have trouble meeting its obligations to lenders. Two common measures of a company's financial leverage are the ratio of debt to equity and the ratio of debt to capital. Equity representing what stockholders have put into the company and capital representing equity plus outstanding debt. To get a sense of how leveraged a company is, it's best to compare these debt ratios to those of other companies in the same industry. Finding growth. Most of the discussion until now has focused on how to value a stock. Of course, the other side of the investing question is discovering growing companies. There are many ways to find great growth stocks. Perhaps the simplest is through your own observations. You may dine at a restaurant chain with an interesting new concept that seems to be opening a new facility every week. Your teenage kids may tip you off to a new store that all their friends are patronizing, or it could be a technology company that turns out one blockbuster product after another. As a rule, you should invest only in companies that you can understand. You can find past growth rates and estimated future growth rates for earnings and sales in brokerage reports and on the internet. If you can find a company that can generate earnings growth of 15% a year, its profits will double in 5 years. If you haven't overpaid for the stock, chances are good that your investment will double over that time frame too. When to sell. The decision of when to unload a stock is as important as deciding which stocks to buy in the first place, but the decision to sell is often harder than the decision to buy. That's because once you own a stock, emotional factors come into play. If you own a stock that falls in value, you may want to hold on to it whether you should or not, because by selling and locking in the loss, you confirm that you made a bad decision. If you own a stock that performs exceedingly well, you may want to hold on because it has treated you so well, even if the stock has become overvalued. The refusal to sell, whether due to unrealistic expectations, stubbornness, lack of interest, or mere inattention, is the undoing of many investors. As a long-term investor, you don't want to cash in every time your stock moves up a few dollars. Commissions and perhaps taxes would cut into your gain, and you'd have to decide where to put the proceeds. By the same token, you don't want to bail out in a panic in the aftermath of a steep market decline. The fundamentals change. Whether you own shares in a large Fortune 500 company or a company most people have never heard of, you need to follow the corporation's prospects, its earnings progression, and its business success as reflected in such things as its products and services, market share, and profit margins. Annual reports, news stories, research reports from brokerage houses and independent analysts, and investment newsletters are fertile sources of such information, along with the references listed on page 10. If a company's basic fundamental measures start to weaken, it's time to reconsider your investment. An example might be a fast-expanding retail chain whose sales per store suddenly decline after rising for years. Or here's a more obvious case. Suppose you bought a stock because you had high expectations for a new product. If the product turns out to be a dud, sell. The dividend is cut. The progression and security of the dividend are important to any stock's prospects. A dividend cut or signs that the dividend is in trouble, meaning that analysts or money managers are quoted as saying that they don't think the company can maintain its payout to shareholders, can undermine the stock price. Beware, incidentally, of stocks that sport unusually high yields relative to their history or to their industries. The yield may be high because the share price has dropped a lot. This often indicates that investors believe a company will cut its dividend. You reach your target price. Many investors set specific price targets, both up and down, when they buy a stock. When the stock reaches the target, they sell. A good target might be to look for a 50% gain within 2 years or to limit your patience with a stock to a loss of 20%. Such guidelines can prompt you to take your gains in a timely fashion and to dump losers before the damage gets too painful. Take the simple step of setting a mental protective stop. Keep track of the stock's price and sell any stock that hits your mental stop point. You can set your sell level anywhere, be it above the current share price or below the current share price. Once you've reached your objective, take the money. If the goals you set are very conservative, you might miss some gains from time to time, but that's better than holding on too long and falling victim to the Wall Street maxim that says, bulls make money, bears make money, pigs get slaughtered. What's your return? With any investment, you should judge performance by total return. Essentially, the change in price plus any dividends you receive while holding the stock. For example, if you buy a stock for $40, sell it a year later for $50 and receive a $2 dividend payout during the year, your total return is roughly 30%, a 25% capital gain plus a dividend yield of 5%. Have a more optimal future. Planning. There are a number of benefits to investing in stocks through mutual funds. Instead of researching individual stocks yourself, you are effectively hiring an investment professional to analyze companies and stocks. The manager will decide when is an opportune time to purchase and sell stocks. Funds are convenient. While you may need to purchase 20 to 30 stocks for adequate diversification, a diversified mutual fund provides a one-stop approach to spreading risk. For example, researching small company or foreign stocks can be especially daunting, but you can fill gaps such as these in your portfolio by buying small company or foreign funds. In fact, you can find funds that address almost any investment strategy, broadly or narrowly defined. Stock mutual funds, which you buy through an intermediary, such as a broker, or directly from a fund sponsor, come in several varieties. Index funds are passively managed funds that seek to mimic a benchmark, such as Standard & Poor's 500 stock index. Actively managed funds are funds run by a manager who selects stocks according to his own assessment of their attractiveness. Exchange-traded funds, or ETFs, typically are a version of index funds. ETFs trade like stocks on a stock exchange, and you buy and sell them through a broker as you would an individual stock. In all cases, it pays to be sensitive to fund fees, which subtract from your returns. Mutual funds are particularly amenable to a technique known as dollar-cost averaging. With this strategy, you invest a fixed amount of money on a regular basis. For example, if you have $10,000 you want to invest in a stock fund, instead of plunking it down all at once, you might choose to invest $2,500 now and $2,500 3, 6, and 9 months from the time of the first purchase. Of course, anyone who invests every payday through a 401k or similar plan is effectively dollar-cost averaging. Dollar-cost averaging offers important psychological benefits. It prevents you from investing all of your money near what could be a stock market top, seeing the value of your investment drop, then having to sell at a loss with a vow that you'll never invest in stocks again. And if you adhere to the program religiously, it forces you to keep buying stock funds as prices go down, something many people would not do if left to their own devices.